The Retirement Cafe Podcast, episode 58, Understanding Your Workplace Pension.
Retired or thinking about retirement? You've come to the right place. Welcome to the Retirement Cafe Podcast. In each episode, we bring you an important conversation with insight, tips and knowledge, all designed to help you live a fulfilling and successful life in retirement. Here's your host, Chartered Financial Planner and Accredited Later Life Advisor, Justin King.
Hello and welcome to the latest episode of the Retirement Cafe Podcast, brought to you by retirement planning specialist MFP Wealth Management. Today, I'm really pleased to be joined by our Trainee Financial Planner, Rian, who here at MFP Wealth Management, who has been studying pensions for his latest pensions exam. Ryan's working his way through a series of exams to achieve his level 4 diploma in financial planning, and that will enable Ryan to become a qualified financial advisor within a couple of years. So, as I say, he's been studying hard and has recently passed one of the toughest exams all about pensions. So he joins me today to explain what he's learned about the different kinds of pension, and we'll also discuss what you need to consider to ensure you have sufficient provisions when you reach your retirement. Welcome to the podcast, Rian. So Rian, just completed RO4 exam, pensions and retirement planning.
Yes.
Well done.
Thank you.
How was it?
Difficult. There was a lot to learn. It's took quite a few months and quite a lot of study hours to get the knowledge. I think pensions is a very broad subject and can get very complicated. And then when you factor in that it's looking at some of the old pension rules and how they've changed, then it was fairly complex.
Right. So what were the key topics?
So some of the key topics, defined benefit pensions, defined contribution pensions, how HMRC taxes pensions, options for drawing a pension, state pensions, and considerations when you're planning a retirement.
Right.
They're the kind of main topics the book covers.
Okay. And
a lot of detail in all of those.
I'm sure. So defined pensions, they don't exist any longer, do they?
Defined benefit? No. We're going that way. No, so that's a lot of the book was covering how there used to be a significant number of those pension schemes and how employers are moving towards what they'd call defined contribution pensions now.
They're still available, of course, for NHS workers and civil servants and those types of things, but most of the private sector have moved away from defined benefit pensions, haven't they?
They have, yes.
Why is that?
So I think it's to do with the cost of funding the scheme.
Right.
So with a defined benefit pension, you're guaranteed a certain income in retirement, normally based on the number of years service with that company. With people now living longer, life expectancy has gone up significantly. It means these companies would have to pay out these pensions for a much longer time than maybe they originally expected.
Yeah.
So that means it's much more expensive to run, and it just makes it not really feasible for them to be able to provide those funds into that kind of pension.
Yeah, interesting that the civil servants are still getting it, and the private sector can't afford them. So somehow the government will balance those books at one point in time, I suppose.
They will,
or we will, I suppose. Okay, so we've got defined benefit pensions where we've got this guaranteed sum, great, and a lot of the clients that we work with have often got that within their retirement planning. And then, of course, there's this other pension, defined contribution. So for the listeners who don't know what a defined contribution pension is, tell us a bit more about that.
So your defined contribution pension really is where you're paying a certain proportion of your wages, and your employer will maybe contributing a certain proportion of wages into your pension pot. And then the pension that you'll get in retirement will be dependent on how much money you have saved in that pot.
Right. So what are the factors that you should take into account if you are? I mean, I think there's we've got this thing called auto enrollment now as well, haven't we? So everyone's getting automatically, if they're not in a defined benefit pension, they get automatically being put into a defined contribution pension. Is that right?
Yes, it all depends. There is a few criteria to be met first, but yes, the majority of people will be automatically enrolled in a defined contribution pension, and under that there needs to be 8% of qualifying earnings paid into that pension each year. Normally that would be 3% from your employer and then 5% that you would contribute yourself.
Right, okay. Sounds great. Is it enough?
Really, if you look at how much goes in, so when I said qualifying earnings, it means that that's not on your total earnings. It's just over 6,000 is where the qualifying earnings begin, and it's up to 50,000. So between those amounts is where you're getting the 8% paid in.
Right.
So really, if you break down what 8% of that part of your salary is, then if you want any income anywhere near what you were earning when you're employed, then the answer is probably no.
No. I can imagine. I mean, a lot of the planning that we've done in the past for people, let's say they were earning £30,000, a lot of people would try and retire on maybe 2/3 of that.
Yeah.
Let's say £20,000. So hopefully they've paid off their mortgage. If they could live on £20,000 plus the state pension, yeah, you can't see how 8% or 8% of the band earnings, etc., is going to equate to that. There's just not going to be enough money going in the pot to be able to pay that pension out. No. When
really it's below 80% because of the below 8%, should I say, because of the way auto enrolment works. Then no. Even with any investment growth over a long employment period, then really it's not going to match anywhere near the income that you'd need.
So you mentioned a point there. Investment growth.
Yes.
Now I know that you were in a pension scheme before you joined us. Well, you're in a pension scheme now, but when you were at the bank, you were in a pension scheme. You obviously chose where that money got invested.
Yes. So this is something that's interesting. So when I was at the bank, I'd review my pension. I think it was instilled in me from my parents that it's a really important thing. Make sure you're in the pension scheme, and the earlier you start it, the better off you're going to be. But the bit that I missed was where it's invested. So joining MFP, straight away start to realise the significance that can have. And I think there may be a lot of people in my situation that may have looked at their pension and know they're paying into it, but not really understanding where it's being invested and what return they're getting from that.
No, and of course, I mean, if you join a pension scheme and you're in it for 20, 30 years, the choice of investment fund and the return that you'll get off that could be significant.
Yes. Yeah, where you've got that long investment period where you don't have the option to take the money out until at least 55, then you really want to make sure that is in the right investment to get you the growth that can support that income. Because, as we've said, when you're trying to work out how much income you need for your retirement, then the 8% that's going in isn't going to be sufficient. But the money that does go in, you want to be growing to hopefully boost that pot of money that you've got.
Yeah. So I think of the levers that people can pull, of course, to try and get a great retirement or financially get a great retirement are going to be the contribution amount.
Yeah.
Pay as much as you can in. And then the investment return that you hopefully can get, the look at the funds that you're investing in. Yeah. And possibly also the charges. I mean, how much you're paying in costs. I mean, that's going to have an impact as well. Yeah,
so I mean, where you're auto enrolled, so the benefit is that your employer has to contribute to your pension. So that's a big benefit. But if you're looking to contribute above and beyond that, then on reviewing the charges that on that pension, it may well be that you could have a second pension that you open yourself and contribute to that one in addition to the auto enrolment contributions. So it makes a significant impact, the charges that you're paying each year to have that pension.
Yeah. Well, at least we know the auto enrolments are relatively low cost, and so that's a good thing. But of course, if people have got pension pots elsewhere, it might even be worthwhile considering transferring their pension pots that they've got elsewhere into the auto enrolment scheme. So it's about just educating yourself, isn't it? It's about understanding what are the choices.
Yeah, knowing exactly what you've got in each pension, what you're paying for that pension, and where it is invested.
Yeah.
Because I think where nowadays people tend to change jobs quite regularly. It's not one job for the whole of your career, as maybe it has been previously. So you can end up with lots of small amounts in pensions, but that might not be cost effective. It may be better to have all of those in one scheme, but you need to regularly review that and make sure you know where you are with each of them.
Yeah. So obviously pensions are a good idea. Now, some schemes or some employers are quite kind because they match contributions. You know, they'll make additional contributions. And I know with a couple of clients that we've helped is that they've done these salary sacrifice arrangements, you know, where you give up some of your salary and the employer will put that into the pension scheme. Of course, that hasn't had any tax deducted or possibly not any national insurance deducted, which makes it even more. It's another lever, isn't it? Another lever that you can pull.
It is. So if you're thinking you want to increase your contributions for the reasons we've already discussed, then it's worth speaking to your employer and understand what options they offer. Because it may be that you're going to get much more money back by something like a salary sacrifice scheme that they may offer.
Yeah.
So really understand what it is you've got available to you before making your choice.
Now, one of the other things I know that we've been talking to a couple of clients about recently, more so for their children, is that it's not just pension savings. There are other things. There's something called a LISA, I think.
Yes, so a lifetime ISA. So this is a new government scheme that's been launched where you can save up to £4,000 a year and they will give you a bonus of 25%.
Yeah.
So up to £1,000 a year. The money you save in a lifetime ISA can be used to buy your first home or for your retirement. So
Wow.
you've got the option of the two. But the big benefit there is the government are paying you a 25% bonus on those contributions.
So you can have that plus your pension. So that could be quite significant.
Yeah, exactly. So it doesn't have to be everything goes into a pension. The important thing is that you're putting money aside to provide for when you have retired. So it may well be that it works out best to have your auto-enrolment pension, but also a lifetime ISA alongside that.
That's right. And I think you can take those out at 18 and you can contribute until you're...
So up to 40.
Up to 40, okay. And then you can either access to buy your first home or you can access at 60.
That's right.
And of course, there's not the complicated rules at 60 like there are with pensions about how you draw down and tax-free cash elements and or whether you buy an annuity, etc. With an ISA, it's just literally you can have the cash if you want it out, or you can take as much or as little out when you want.
Yeah. That's the real benefit of the lifetime ISA is that there isn't any of those considerations. You wouldn't have the tax relief when you're paying the money in. However, when you do retire and when you reach 60, then you do have that pot of money available to use as you need to.
No, you get but of course you do get the tax relief bonus added, don't you, as you pay the money in?
Yes. Yeah. So it would have come out. You would have already paid tax on your income, so the money would have been taxed. Then you pay the money into the lifetime ISA and get the government 25% bonus.
Great. So there's a number of different options available, isn't there? Now, a lot of people, there's quite a lot of complexity. I mean, you had to study, I don't know how many hours to pass this exam.
So around 50 hours
Around
is
50
what they
hours.
recommend,
Okay.
and I think I must have been close.
Yeah, sure. So you can't expect maybe members of the public to go and do that. Where can they get help? Where can they get help? Where can they get advice?
So if they don't have a financial advisor, which you may not, then you've got PensionWise. So this is a government guidance service that they've launched because they appreciate it is very complicated. So the PensionWise, you can book an hour appointment over the phone or book to see someone locally, and they will give you guidance and go through all the options you have open to you and try and help you work out what will be the best way for you to take your pension.
Right. So it's really aimed at how you take your pension rather than saving for your pension.
It is, yes. So they've got lots of guidance on their website which will talk you through all the way from how pensions work and the contributions you make. But the appointments are for when you've reached the age of 50 and you're really looking at those options for taking your pension at beyond 55.
Right. So try and get yourself educated, try and do a bit of reading up and try and understand. I mean, if you're in an employer scheme, there's probably people at your company who probably have a bit of a clue maybe about how these things work and you can lean on to get some guidance maybe from them as well. But read the information that they provide you and understand what you're doing.
Yes, you will get information through every year, at least every 12 months. You will get information through about the contributions you've made, how much is in your pension pot, and normally quite a lot of other information about how everything works. Quite often there'll be a contact number there where you can call and you can ask questions if you're not understanding something we've touched on, where the funds are invested. It may say where they're invested, but you may not fully understand what that means. So you should normally be able to give them a call and have that explained in a bit more detail. And like I say, other people in that scheme can probably help you as well and give you a bit more understanding of why that scheme's set up the way it is.
So trying to work out how much you should be paying into your pension. I mean, if you've got a defined benefit pension, that's quite clear because you get a statement to say what you're going to get. I know the state pension has a state pension forecast service. We can put a show note link in for the show notes for that to tell you what the state pension is going to be, because that's quite a good underpin as well.
Yeah.
And then there's this money purchase pot that you might be contributing to, which is how much do you need?
Yeah, that's probably the big question everyone has. It's a difficult one because you really need to be looking ahead to your retirement and thinking, well, what income am I going to need to live the way I want for my retirement? So what plans have you got for your retirement? What age do you plan to work until? And will you go part-time, or will you just stop work as soon as you can? And then work back from there, really. You need to have some kind of idea of what your retirement looks like, and then you can start looking at how much you contribute and is that going to be sufficient to get you to that number.
Yeah. I mean, I don't know whether I'm just particularly pessimistic, but I do view for every £10 I put into my pension, I just think, well, that's £10 coming back. Because I hope the investment growth rate will be at least what inflation is. And if it's a bit more, then that's great, fantastic. I'll get to my retirement age earlier than I expected. But I think, every £10, every £100, that's £100 in. That means I can have £100 back out. Now, there are some tax rules when we take money back out of pensions, aren't there?
There is, yeah. So from 55, with the new pension freedoms, you can take 25% of your pension tax-free. That could be in one go, as a lump sum, or as a proportion of future withdrawals.
Right.
But you are entitled to 25% of the entire pot tax-free.
Okay. And the rest is taxed how?
So it'd be based on your marginal tax rate. So like when you're employed, depending on how much you earn, in line with the government tax bands at that point. So at the moment, 20%, 40% or 45%.
Right.
So it'll be dependent on your total income and taxed in that way.
Yeah. And of course, the good news is that if you do have a money purchase pension now, that they can be inherited by your spouse or your family members or whoever you nominate if you don't make retirement, or even if you maybe pass on early into your retirement.
Yes, so you can nominate who you'd like to receive it. There is some reasonably complicated rules, but it's dependent on when you might pass away, whether it's before 75 or after 75. Affects what tax implications that has for the person inheriting it. Yeah. But yes, it's outside of your estate for inheritance tax purposes.
And of course, annuities, which is people may be familiar with, and we have touched before, but on previous podcast episodes. But annuities have been deemed to be quite poor value for lots of people in recent years, purely because life expectancy has gone up and interest rates have gone down.
Yeah.
But I think sometimes maybe a mix and match. Maybe some of your pension could come from an annuity and some of it could come from a drawdown. What are your thoughts around that?
Yeah, I think that's definitely true. I mean, it doesn't. You've got various options for your pension, but it doesn't have to be that you take just one option and that is your final decision. You can have a mixture of the two, and you can hold off your decision until further into your retirement and then look at annuities or other options. So I think it is a case of keeping your options open and not feeling like you have to make one decision at age 55.
Great. Well, that's been really useful. You've obviously learned a lot. What's the next exam?
So at the moment, investment, principles and risk.
Wow, okay. So how many more have you got to do before you get to your diploma qualification?
So I've got three more exams to sit. So I've got investment risk and principles, then on to the module on taxation,
Right.
and then the final exam, which is case study based.
Wow. Okay. Well, good luck with that. And
Thank you.
some study maybe over the Christmas period, but
Yes, I think there will be.
so enjoy that. And once again, thanks for your time.
Thank you.
If you'd like to find out more about Pensions Wise and how to request a state pension forecast, check out the show notes at our website, theretirementcafe.co.uk, where you'll find some useful links and the links that you need to do that. If you've enjoyed this episode, then please leave a review on iTunes to help more people like you to discover us. It really does help. You can also subscribe via iTunes or your preferred podcast player so you never miss an episode. Next week, I look forward to welcoming Lisa Snyder from the Institute for Preparing Heirs to chat about successful wealth transfer and how to avoid the old adage of shirt sleeves to shirt sleeves in 3 generations. So until next time, this is Justin King helping you feel more informed in your retirement.
Thank you for listening to the Retirement Cafe podcast with Justin King. To find out more, you can find us online at theretirementcafe.co.uk.